out some new stuff. Randy and I have this. We're trying out some new stuff. Randy and I are. In the lab, cooking it up, see if it works or not. We'll see. I don't even know if it's working. Yapping about stocks. We'll talk some shit. We'll have some fun. I just dropped the scanner and I'm already getting people DMing me some bullshit. First one, when creating filters, can we get it to narrow the available selections under industry to only those inside that actual sector selected, or if I select the industry first, then force the sector to update to whatever corresponding? Is it because there's too many industries? I think there's 166 listed. I just want to make sure that that's what you're trying to do. So for example, if you click tech first, you only want the tech industries to show up, right? That should be defaulted. If it's not there, I can absolutely push that, but I want to make sure that's what you mean. Okay. I see the live on X. I don't see it on YouTube. Let's see. Let's check the YouTubes. Is it not live YouTubes? Well, where are we? Where are we live at? So why we're doing it trial run here. See how it works. Should be good now. It was unlisted, that's why. I'm a dummy. Pop out the chat. Look at that. Good. We're live on YouTube. We're live on Twitter. I work in IT, so I just know too many options are going to break people's. Well, I mean, it's a quality of life change, and it's an easy fix. It's like probably a 30-second fix. Is the code published on GitHub? It will be. Right now, I'm just. It's all local. It's in your DM, Arvin. I already DM'd you. These app sessions right now, yeah, they're public, they're live. I'm messing around with the settings. I mean, we're gonna talk stocks here. Don't get me wrong, but Randy and I, we're messing around with. We're gonna be going live publicly, so I'm messing around with stream quality stuff and like getting scenes and everything set up. We're doing it live though. I'm not. Fuck it. We'll do it live. Anyway. Max asked for Rubrik. Let's see. No, yeah, this is fine. Public. It's all public. By the way, for those of you that are watching the stream, Rubrik was an IPO-based breakout, was absolutely phenomenal. I know I talk a lot about IPO-based breakouts, but I mean, I'm telling you guys, there's very few setups in the market that are as repeatable, as scannable, and as beautiful as an IPO-based breakout. These things are fucking incredible, man. If you can scan for them, the TTI scanner has a setting there, so you're going to be able to find them. If you're using FinViz, you can use our Big Blue Sky breakout scan as well. That finds them. But again, IPO'd back in Q2 2024, built the base out in October of 24, then absolutely ripped, and we caught essentially the entire move to the upside. So Max is asking, what about it now? It looks fine now, particularly because we know this is a software-related name, if I'm not mistaken. Engaged in the provision of cloud data management solutions. Let's see, what's the market cap on this thing? 20 billion. I don't know if it's going to be in the TTI scanner or not, but we might be able to look here. Let's see here. It is TTI score of 78. Nice. Okay, cool. For those of you that are using it, by the way, it updates at the end of every session. So I already said that, but just to point it out again. Yeah, it doesn't look bad here. Looking for an all-time high breakout, I'm assuming. Earnings report in 16 days. Little gap and go here a couple of days ago. Never filled the gap, indicative of the underlying, or the strength of the underlying trend there. So bullish momentum regime, cross back up and over above the zero, so reacceleration and momentum. Stacked on top of 3 upward sloping 200-day moving averages in general. Top of the 200-day moving average. Yeah, I mean, this is about as cookie cutter of an all-time high breakout as you could possibly get, risking the $100 area. Volume falls off at 100. I wouldn't wait till 102. If you could get in front of this prior to the all-time high breakout and potentially sell a double within the next 2 weeks prior to earnings, this would be one of those trades where you'd be in a good position to make the decision on whether or not you want to hold it through earnings, risk-free or not. You don't have to, but completely up to you. It's a nice little chart here. Speaking of which, let's go ahead and run a 50-day high scan really quick and see what's up. Shameless shout out to Godell. He's doing some research earlier on some energy related stuff here. Not bad, not bad. Look at the private equity baskets. Or basket. Look at these names. APO, KKR, Ares, Blackstone. And we're in the KKR. Which is great. Sold the double relatively early, held through the uncomfortable drawdown, but completely risk-free. Now we don't have to worry about catching it back to the upside unless we want to. Look at this thing. Look at the beast pressing up in towards new 50-day highs, coming up in towards potential new multi-quarter highs. Where's our equally weighted basket? Look at that. First time up and over the 200 moving average this year, basically, at least since the meltdown. This also bodes well for financials in general. Finally, some of the more speculative PE names are going to be contributing. Should bode well for regional banks as well, just pressing up into 4-year highs. Very close to all-time highs in regional banks as well. So we have a position. We have a position in a couple of these banks here. Bank of America pressing up into all-time highs. We have a position in. Not bad. Let's go and look at some 50-day high scans. All right. Is this like the one restaurant that isn't apparently being impacted by Ozempic, or like what's going on here? I remember we were talking about buying at least one of these small cap consumer discretionary names. There's a lot of them on the list that we're breaking out. Apparently, Cake's the one that took the cake. 66 to 111. Is this a Berkshire target or something? Because this is crazy. By the way, number one stock on our list was for energy was MPC. We have MPC, Phillips 66, Valero, Energy, finally popping up back onto the top 10. Probably not something that's going to go away. I know there's a lot of people right now that want to short oil with the pop, but check that out. Little gap and go. If this thing holds, we're up and over our anchored VWAP from the highs. C limited. This was kind of a disaster of a breakout, to be honest with you. Expected a hell of a lot more in stage 1 into a stage 2. By no means was this a bad move, but expected a hell of a lot more out of C limited. But here we go. Found support at the previous bear market highs. Dug in for a couple of quarters, breaking back out. We're now above all 3 moving averages, above an anchored VWAP for late 2025 highs. This is supportive above 120. C limited giving some international exposure. This is what Southeast Asian ecom, right? Ecom digital financial services out of Singapore, right? So there we go. We had C limited, and then we also had Coupang that was moving relatively the same, but Coupang has not found support at its previous bear market high. So C limited should be on the list of names if you're looking for some international exposure there. It's a nice reclaim of an uptrend post drawdown back towards previous cycle highs, ticker SE. Not bad. You'll see. Messing around with it. I mean, that's not a bad chart, right? SC doesn't look bad. SC does not look bad. MPC, again, number 1 energy stock on the list. Blackstone back on there. TGP. You know, I'm looking at names like PNW. I know we had this conversation yesterday, but these cybersecurity names that are already like in La La Land, like you have PNW. I mean, this is unbuyable at this point, right? You're either in it already or you're not. This is unbuyable, particularly from an option standpoint. It blows my mind. Like, you know, for whatever reason, CrowdStrike drew down on the 14th to $91. It's currently trading 223, up 145, 146. There's no entry here on CrowdStrike. There's no entry on PNW. There's no entry on Net. I mean, all of these are too far gone at this point. And yet people are like obsessing over them, and I get it. There's a lot of strength here. Cyber's up into all-time highs. I mean, just a beautiful move. Who would have expected post Leopold Ashenbrenner blow up that cybersecurity would continue its advance higher, particularly at the velocity that it is? But it is, and if you weren't in it earlier, trying to chase the one industry group that did not get killed during the Leopold Ashenbrenner blow up is ridiculous to me. You're paying an absolute asinine amount of implied volatility to get into something that's already up 200%. Like, that's crazy to me. There's a lot of different stocks and different industries and sectors, et cetera, that are breaking out. Private equity showing a move here. I mean, SE, right? You're nothing to do with situational awareness. You have energy-related stocks. You have all these things that are looking really good right now, and yet people are like solely focused on the one type of stock that's working right now. And it just so happens that everybody is looking at that stock. It's crazy to me. You get like, it's a groupthink. Speaking of which, look at Twilio. This is a name that we've traded a couple of different times this cycle. Don't own it right now, but another gap up into new multi-year highs. These are the types of stocks that you should be looking at, not the things that are like left over from the Ashenbrenner blow up. Like, terrible groupthink on X, where if you're not talking about the AI bottleneck trade, you get no engagement. So I know that there's like a lot of the reason why people are solely focused on that from a content creation standpoint is because that's what gets clicks right now. But terrible fucking trading vehicles at this point. We've talked about this. Semiconductors, as long as they're still below the neckline at somewhere around 590, like it's just ridiculous. This is a potential beginning of a new lower low. You're below some pretty important moving averages. You're below some pretty important technical levels. You're fighting through overhead supply. You have an incredible amount of stocks on the market right now that are probably going to get sold. You don't think Citadel is going to sell that stuff off? You think they're just going to continue to rip it higher? Probably not. That's not what they do, historically speaking. And yet people are solely focused on it. Like the AI bottleneck trade was a historic route over 3 months, 2 months, 3 months. It's over, at least for the time being. You can build a watch list and revisit it every so often. So when stocks start showing back up, to the upside, it's great. But it reminds me of like the move in silver. Right? Move in silver peaked in late January, and there were people that were still trying to buy. People justified buying silver every single week since then. And really, at least in my opinion, this is really the first week, or last week was the first week where we saw like a legitimate opportunity to maybe buy it. We've been out of it for 6 months. And I don't know if semis are going to be the same way. I don't know if it's going to take 6 months for them to show up again. But I do know that they've had plenty of spats of underperformance during this bull market. Like, how about this entire move? In the middle of a bull market. And yet semis did nothing for an entire year. And as a matter of fact, from peak to trough, they culminated in a 42% drawdown. Can you imagine that? Semis drawing down 42% in the middle of a bull market. It happened in 2024. Like, it's crazy. We saw some big moves late last year as well. I mean, these drawdowns are not small. 16% move. In March of this year, we had another 16% move. And now we're currently sitting at 14%. And we were down at 1.24. It took over a year to figure itself out. I don't think it's over. Obviously, this market is dominated by semis, but I do think that like if that's the only thing you're focused on right now, that's insane to me. There's a lot of opportunities. You have the S&P at all-time highs. You have the R2K pushing into all-time highs. We had weekly all-time high closes on these. You have mid caps. So many good opportunities in mid caps right now. If your account's not like $10 million, which I don't know many people that are, you should be looking to take advantage of these mid-cap and small-cap names. There's so much opportunity in this part of the market. Mid-caps are pressing into all-time highs. In my mind, it's so important that we have a market cap that's specifically for under 10 billion. Under 10 billion is a great place to play as long as you respect risk, because the larger financial institutions don't have the ability to get in there and mess around with a whole lot of stuff because they're too big. It's not worth their time. Retail traders can get in there, and there's a lot of volatility in there. And again, volatility is not enemy. Volatility is opportunity, as long as you can respect risk. But no one wants to play in those because it's not like the sexy MUs or the AMDs or whatever is hot right now. I'm looking at a market right now where we have 40 names, breaking out with over 1 million volume on average, with over 1 RVol. So these are strong candidates today. Over 1 RVol, so relative volume over 1. These are all breaking out. This is not proprietary. You can steal this scan. I don't care. It's a basic 50-day high scan with momentum behind it and some volume, some institutional volume there with the relative volume. Look at it. I mean, very few of these are going to be the AI-related names. Check this out. Go and look at them. How many tech names in general are there on this list? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14. And how many of them are situational awareness related names? I might mess this up, but I don't think there's too many of them. I don't think he owned Fastly or MongoDB, Palo Alto, or SAP. Like, these are not like the AI bottleneck trades that blew up. I can't believe Uber's on the list. There's a lot of opportunity out there right now if you're willing to look outside of kind of what the groupthink on Twitter is. Groupthink on Twitter is terrible, man. It's so bad. It's even gotten worse, I think. Really, I think it's gotten worse. Like in 2020 and 2021, it was like the GameStop AMC stuff, and it was just dumb. But now it's like they're basically only talking about the AI bottleneck trade, and if you talk about anything else, there's no traction anywhere. It's just like, I don't know, it's just bad. Year-to-date performances, by the way, this might throw people off guard, but energy is outperforming tech year-to-date. Can you believe that? Energy is outperforming tech. Like, that's insane from an industry standpoint. Semis are still going to be number one, but look at the drawdown. We were up near 90%. Now we're up 60, which is still great. Don't get me wrong. But this is a backside fade as far as I'm concerned, at least right now. You have oil services up, oil gas exploration and production up, you have AMLP up. You even have some recent resurgence here in software and internet. Where's internet? Internet. Check this out. You're up into 6-month highs in software. So yeah, semis are struggling a little bit here, but software is not. Check out internet. Internet stocks are at all-time highs today. This week, finally, the first time in quite a while, internet stocks are breaking out. So like, again, everyone's focused on semis and the AI bottleneck trade. You want to know where I think the bottleneck trade is? Is the basic materials related names that like the market's going to need to build out this AI infrastructure. Like that's where the bottleneck really occurs. I don't know if there's going to be a squeeze in copper, but copper's at all-time highs. It's a good trade there. I'm not going to endorse some of these copper miners because they've traditionally been pretty tough to trade, but you have some US related copper miners and FCX that's breaking out into all-time highs. Southern Copper breaking out into all-time highs. Another one. You have some international flare, a name that we've owned in the past, and I actually prefer this name as a trading vehicle. ERO, which is an American or Canadian name that rips copper out of the ground in Latin America. Look, none of these names have anything directly to do with the AI bottleneck trade, but these are second and third magnitude orders, right? And these things are breaking back out to all-time highs. Whereas the other names are pulling back 50, 60%. It's crazy. Then you just had the Yenervention, and you saw gold and silver immediately respond. So here's gold on the weekly last week. I mean, that's as great of a candle as you can possibly hope for if you're looking to get long gold. Silver, a little bit higher beta, so it's going to be more aggressive. Great candle last week as well. And we got the follow through on some of these gold miner names. So if you like the gold trade, but you want a little bit more beta there, you can go into the gold miners, get some single stock risk if you want it. Look at the stick on gold miners. There's plenty of names that you can choose from. Right? We made some money last year on Kinross, KGC. There's a stick. Don't own it right now. Agnico Eagle Mines, we made a lot of money last year on it. That's a stick. We don't own it. We bought Newmont. We're up on Newmont. We're actually very close to 100% move on Newmont, so we're looking to sell the double relatively soon. But Newmont is 10% of gold miners, the ETF itself, GDX. So think about like from a risk standpoint, you know, you can own gold, which is what, if I can type GLD, which is sitting at like a 1 point something %. You can own GDX, which is sitting at like a 2 point X something. And you can own an individual stock within GDX, which is a 2.87 ADR. So again, it's just how much volatility do you want to incur within the single trade? You don't want to go and buy GLD, GDX, and NEM. That's insane. They're all the same trade. But it all depends on what you're looking to do from a volatility standpoint. Would you rather get the GLD position at a 1 point X, the GDX position at a 2 point X, or the NEM position at 2.87? With greater volatility, obviously comes the possibility of a greater loss, right? Volatility works both ways, up and down. But with GDX generally, or with NEM, you're going to get the benefits of a single stock. So GDX might have, in aggregate, the entire gold mining industry under its belt, but with NEM, you're going to get what happens if Newmont comes out specifically and says, we just found this huge deposit of new gold. All of a sudden, you're going to get the absolute performance from the NEM announcement that might not directly translate into a GDX style move, because Newmont is only 10% of GDX. Likewise, if you like Newmont, but you don't want to incur that single company risk, because what happens if Newmont comes out, reports earnings, and says, we blew it, well, maybe Newmont's down 20%, but GDX only has 10% exposure to NEM, and so GDX is going to hold up better. So it's a hierarchy of risk. Whatever makes the most sense to you is what you should be looking to take. We also took, we didn't take silver miners, but we talked about silver miners as well. So SIL and GDX, these are probably going to work in the same direction, but like I was just talking about from a volatility standpoint, GDX moves at a 2.91 and SIL moves at a 3.32, so higher beta there for SIL. And then we looked at CDE as like our high beta silver miner exposure. A little bit more of a risky entry because we bought it prior to earnings, but unironically, earnings actually didn't go well, and yet it's still up. Close to selling the double in CDE. So an opportunity like this, the reason why I bring this up is it's very different than what most people are talking about. Most people are talking about the AI bottleneck trade. Most people are talking about the semiconductor trade. Most people are talking about the Ashton-Benner blow up. Everybody's looking to fish. Everybody wants to ton the bottom on this stuff, and yet you have an entirely different asset class, an entire different sector, an entire different industry groups in general that are breaking back out. It's all rotation. It's rotation and rotating out of the overinflated, well, maybe not overinflated now, but the exasperated AI-related names, and they're going in towards some of the other areas of the market. Maybe the intervention was like the catalyst that kickstarted all of this. I don't really care about the catalyst. I care about the fact that we're able to identify what's going on at the pivot and then participate if it makes sense. At least as of right now, we are participating within the precious metals trade, and it is making sense. We got a good head start on that. But I mean, here's the thing. The people that have been buying on the way down are going to sit here and say that they nailed it, which is fine, whatever. It really depends on your trading style. But for those of us that are trading options on top of this, timing matters. And so if you've been buying gold and silver since the January peak, you did not nail this. You did not. I mean, you did not nail it. We haven't nailed everything this year by any means, but the gold and silver, if that was the bottom, we nailed the pivot. And we now have an opportunity to own this stuff through the end of the year if we want. We were able to position ourselves in some January 2027 contracts, very close to already selling the double in a couple of them, which gives us risk-free exposure through the end of the year should these trends continue to materialize. And if they don't, which oftentimes happens, by the way, very often trends do not materialize at the length that you that you think they will, or that you wish they will. But the fact that if you're able to manage that risk by selling doubles, for example, in options, or moving stops up in commons, you have the discretion to close whenever you want. And at least from an option standpoint, if you've already sold the double, anything you pull back, even if the contracts go down negative 75%, is profit. It might not be a big profit, but it's a profit. You've already sold and covered your original premium that you paid, right? So some good opportunities here in precious metals, in miners, if the trends continue to persist, which I think there's a good chance that they will. Some potential big wins here towards the back half of the year. It's all about managing risk first, though, and getting out in front of those by selling doubles. And then energy. The other big theme right now is energy, and it's been a tough trade. I want to point out that if you're in TTI, we talk about this all the time, but secular markets matter. This was a secular bull market breakout in energy back in January, February area. We had a position on Exxon very early on, so we were able to participate through basically the entirety of the move. Q1 ended up being a historic quarter for energy, up 40-something%. Like we had talked about, energy probably not being able to repeat that in Q2. History kind of states that after a monster quarter, energy tends to underperform, and that's what we saw in Q2. And now all of a sudden, out of nowhere, energy's right back up. And you can point fingers at the geopolitical situation. You can point fingers at, Trump tweeting on Truth Social, or whatever you want to call it, posting on Truth Social, whatever you want. It doesn't matter. What matters to me is whether or not you're in a position to make money, or you're just going to sit there and complain about this stuff. If you want to just sit there and complain, that's fine too. You could probably, you're going to get a lot of clicks on Twitter. and maybe with the Elon bucks, you make a lot of money through content creation. But for those of us that have money on the line and we want to make money in the markets, we don't have the benefit of just sitting there on the sidelines and complaining about this shit. We either participate or we move on to a different area of the market, right? Energy, secular bull market breakout. This is probably not going away, not for weeks or months, but years probably. That's how these secular bull markets work. You get these moves, they're secular trends that last anywhere from, I say quarters to years, but it's really years and sometimes decades, particularly if you're thinking about like the S&P 500 and the Dow and these major indexes. This could be a theme for the entirety of the 2020s at this point. It already has been, by the way, energy performing very well off the 2020 bottom back in March of 2020. And then you got the big pop up through the Russian invasion of Ukraine, and now you get the big pop up through the American whatever invasion of Iran, whatever you want to call it. So probably not going to just go away. I know everyone's focused on the price of oil. People, are trying to call the top in oil and short it down. Feel free. That's not my game. I'm looking at a structural uptrend here that started in Q1 of 2026. I want to participate. And here we got, another month or another quarter started, where energy is in control again. Quarter to date, energy's up 14%, followed by financials, healthcare, materials, comms, all outperforming the S&P. To the downside, you have Utes, tech, and real estate. Really, those are the big laggers there. But 14% in energy quarter to date. After we just had a quarter where energy got killed, and tech absolutely took the baton. Here we got a little bit. Again, sectors are rotating. You have gold miners outperforming right now from an industry standpoint. So again, we're grabbing those gold mining exposure through NEM and some of us through CDE. Software, I continue to think software is probably going to have its time to shine right now. I like software better than semis here. I like internet stocks better than semis here. Both of those up quarter to date, whereas semiconductors are down 12%. So, like I said this yesterday on Twitter, and Randy was like, that's a good quote, was you can try to time the bottom on this stuff, but it's never a bad time to buy strength. And there's a lot of things that are breaking out right now. It might not be the things that are interesting. It might not be the things that are getting clicks on Twitter. But again, if you're interested in owning uptrends, there's plenty of uptrends across the market right now that you can own. Energy trade will always be around as long as Trump's in office. I mean, energy trade, well, how about this? Think about it this way. Here, let's run this really quick. I'm going to show you something and everybody watching this. If you think this is just a Trump thing, I think that, not you in particular, Arvin, but I think that you're very you're undereducated, whatever you want to call it. If you look at the track record of the Trump administration's first go around, so what was it? Something like January. I hate this. Koifin just absolutely sucks when it comes to this stuff. 1/1/2017 to when did he get out? We'll just do 1/1. 2021, something like that. That was the first Trump admin. If you go and you look at energy, it's the worst. This is the first Trump administration, the absolute worst. And then if you throw on, for example, PBW, which is clean energy, and if you throw on TAN, which is solar energy, look at this. You have solar up 538%. You have clean energy up 495%, right? That's crazy, because you're thinking about it, the Trump admins drill, baby, drill. The Trump admins screw, renewables and everything else. And at least that's what the media says. And yet the market went out and bought clean energy and solar and everything else. And this is even prior to the breakdown, because people are like, well, that's only because they were higher beta. No, they were already leading the market higher prior to the COVID breakdown and then recovery. And then you get into the Biden years, which was the exact opposite, right? Biden was, or the Biden administration, was, okay, let's reinvest in renewables and solar, and we don't want anything to do with dirty energy. And yet, look what happened. Dirty energy outperformed 164%, and what were the worst performing? Solar and clean energy. So it's unfortunately, I talk to people on a weekly basis that use politics as a way to justify their miscomings in the market. And if you go and you talk to them about the stuff we're talking about right now, they get mad at you. When in reality, it's their fucking fault. they refuse to step out of whatever crazy shit is going on in their brain and look at the markets objectively. Now, that's not me sitting here trying to give my political opinion on things, but the market will make you pay. If you have tunnel vision and you don't have the edge that you think you do, the market will make you pay. It'll take your money. So under the first Trump administration, energy got crushed. And then renewables did really well. Under the Biden administration, the exact opposite. Energy did very well. And now clean energy and solar are crushed. And then, just to kind of round this off, and I haven't even run the numbers yet, but if we just went to what's going on right now, look at that. First Trump administration, or second Trump administration. Clean energy, tech, and solar are outperforming energy. That's exact opposite of what you would expect in a market where he's kind of championed this drill baby drill thing. So I don't know. Again, the market will make people pay that can't look outside of their own political views, that can't look objectively and come into the market with a reasonable stance. I was just reading yesterday on Twitter, some joker started an account 2 years ago, and he just screams autistically into the void about everything that sucks. Besson sucks, J Powell sucked, Kevin Warsh sucks. All these people suck, and he's been able to run his account up to 40, 50,000 people in a year and a half. He sells a subscription, which is fine, whatever. But it's his idea of farming engagement is just giving into the drivel of the masses. Because again, it took me 2 seconds to show you that Trump is not bad, at least in the stock market for clean energy, and Biden was not good in the stock market for clean energy. You wouldn't expect that logically. You'd expect the exact opposite. So energy's not going away regardless of whether or not it's Trump or not. This is a secular breakout. This transcends political agendas. This transcends political cycles. You can go back and look through history. A great chart that we have on Twitter that I've built out that mirrors basically the Bank of America global stuff is that, these secular bears and secular bull market cycles last anywhere between 15 to 20 years. How many switchbacks and forths do you think we had between Democrats and Republicans during the meantime? Quite a lot, right? It wasn't only Republicans were in office from 80 to 2000 and only Democrats were 2000 to 2013. No, you had Reagan in there, you had Bush, and then you had the Clinton years. Right, so we had, basically a decade of Republicans and then a decade of Democrats, and then you come into the 2000 to 2013, and we had 8 years of Republicans and basically 8 years of Democrats with Bush again, Jr. and the Obama era, and now we have Trump, Biden, and Trump again, and it's these secular cycles transcend political cycles. So when I look at something like an energy sector that's breaking out for the first time really since 2014, but even 2014 it didn't meaningfully break out over the 2008 high, This is probably, this is a thing that's going to transcend the Trump administration cycle. This is going to be something that's probably going to be talked about for a long time. I think that whenever this current AI bubble pops, which I think it will eventually, but I think we have a long way to go. So I think we got at least until 2030. If you look at it from a liquidity and a credit cycle standpoint, I think we got at least until the end of the decade. Energy is probably going to be a portion of your portfolio throughout the entire thing, and who knows? Maybe at the end of this, when the bubble pops, we go back to kind of what we saw in the 2000s, where for those of you that haven't done kind of the historical research on this stuff, look at this really quick. Go back to 1/1/2000 to, let's just do 1/1/2000. When did the GFC start? Somewhere around here. You're going to see energy really just outperform. Look, energy. So we had an entire decade post.com bubble blow up where energy absolutely, beat everything. Financials were doing good up until the actual GFC blow up, but it was a decade of energy. Can you imagine that? A lot of people started trading in 2020 that are probably listening to this, but for those of you that were trading in the 2010s and even the 2000s, which I started in 2009, we had an entire decade where it was materials and energy and financials and to a lesser extent utilities were absolutely, that's what led the market. It took Microsoft, one of my favorite little kick in the face, post.com bubble blow up. Look how long it took Amazon to get back to all-time highs when TradingView finally loads because this program fucking sucks. Look at this. We peaked in 2000, 99. It took until October of 2016 to break out again. So 16 years, basically. 16 years before Microsoft was back at all-time highs. It's unfathomable now that would happen. It wasn't just Microsoft. Amazon was a lot quicker, but still, multi-years, where these Mag 7 stocks, these big tech stocks that supposedly are like the most important companies in the world. Post-dot-com bubble blow-up, these things took forever to get moving again. This thing peaked in December of 99. It didn't break out until 2009. 2000, 2010s, 2010s, 2020s, and every decade there's churn. Some companies are in, some companies are out. Very few have remained on the list the entire time. Very few. So when we get into the end of this secular bull market, which again, I'm not sitting here saying it's coming anytime soon. I'm not a doomsday prepper. I go off liquidity and credit cycles and kind of think about the broader term stuff a lot, sector rotations, industry rotations, things like that. I'm looking at it, I'm thinking that we have a runway out through the end of the decade, 2030 probably, before any sort of real bubble starts to pop, if it even does pop at 2030, I don't know. Like the averages state that this thing could go into the early 2030s if it wants to. Averages, are rarely correct, but it wouldn't be out of the realm of ordinary if it did run into 2031, 2032. It would not. But from a credit and liquidity cycle standpoint, this thing has legs. And for those people that want to fight it, I think they're fighting a losing battle. You might not want to own it all. For example, that like we looked at semiconductors kind of underneath the neckline there, and very obviously damaged post Leopold Aschenbrenner's blow up. But do you really want to short this stuff? Are you really like, I just had a strange engagement with StockTwits on Twitter who, I don't know. It's got to be either somebody that is just trolling for engagement, or he's like a 12-year-old that was hired to be an engagement farmer on Twitter. But Palantir lost like 50% of its value, and the StockTwits account was like, bears are idiots or something like that. And I'm like, what are you talking about? Palantir lost 50% of its value over the course of 6 months. By any rational, answer here would say that a Palantir short was probably not a bad idea. It lost 50%. Now it's up a lot right now, and I didn't short Palantir. It's up a lot, which is fine as well. But I said, like, Palantir lost 50% of its valuation. How are you going to sit here and say that shorting wasn't like, or that bears got blown up or whatever? It's like these companies don't have to go to zero for a short to make sense, right? Most companies are not going to zero, at least not yet, right? That's not how this stuff works. And if you're short biased, you're not looking to short a company to zero. That was part of the problem with NVIDIA back during the big blow up days of 2022, right? NVIDIA, from a bear's perspective, this thing drew down nearly 70%. And people on Twitter were still screaming that it was overvalued. You're the most valuable company in the world, lose nearly 70% of its market cap, and people were still saying it was overvalued? Like, they were insane. 70%. These things are not going to zero. But from the flip side, the StockTwits thing, which again was just a bizarre interaction, where it goes, well, Palantir's up 30% in a week. I'm like, but it was down 50% over 6. You cannot rationalize that bears got blown up after 6 months of being right just because it's up now. Like, it's not how trading works. That's not how this works, right? You don't have, first off, you don't have to be married to a thesis. If you're wrong, you just get out. For most people that know what they're doing, at least, you don't have to like ride the position out to oblivion just because you need to be right. At least I hope not. That's the whole point of being here. Listening to me yap, profits over profits. You could be right and still not be rich type thing. Focus on making money, and if you're wrong, just get out type things. It's not easy, but you have to learn how to do it. So like, again, Palantir down 50%, up 30%. It's a roller coaster. These companies are probably not going to zero. So if you're shorting this stuff, I think you're insane. The bubble is going to continue to bubble. Well, that's another thing. Burry's a seasoned vet when it comes to shorting. But again, it's good content to make fun of him. I mean, that's how this stuff works. Most people don't know what they're doing in the markets. So if you like make a post making fun of Burry, people are going to be attracted to it like flies on shit. That's how this stuff works. They're just, it's not dumb. It's just ignorance. But if Burry shorts a stock and it drops 20%, he covers and moves on. Like, again, Burry's not looking for Palantir, for example, to go to zero. Palantir drew down 50%. If he just grabbed a fraction of that short, he was successful. But that's not content for Twitter. Twitter is, you're short this stock, you're a dumbass, blah, 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 blah. And it's just like, what are you talking about? It's just an opportunity to seize profits. If you're a short bias trader and you see an opportunity either through charting or through fundamentals or whatever, you're just looking to take advantage of a very short-term time period to bring in capital. It doesn't mean that the company is going to fucking zero. But again, it doesn't make good content. You got people, some of the most popular people on Twitter with cash tags of stocks in their profile. That's when you start to see like the goofballs with like 100,000 plus followers, and they have like hashtag whatever in their, or cash tag, excuse me, whatever in their profiles, and it's like hymns or like some other meme stock. Like, stay the fuck away from those stocks. That is institutional, like a bullseye for fucking institutions to come in and try to pull liquidity away from retail, hedge funds, institutions, etc. Like, they'll see people like build these big archetypes around stocks, and they'll just sit there and wait and wait and wait. And then right when it's the right time, right when you can't afford to sell, is when they come in, just like the Leopold stuff, and they blow up the stock, and then everybody that's holding it loses. And everyone gets mad at the shorts and not the asshole with the fucking cash tag in his Twitter account that made, you know, hymns or whatever it is, his personality. It's insane. It's crazy stuff. Crazy stuff. Okay, any charts you guys want to look at before we break for lunch here? About 5 minutes, and I'm going to go to lunch. I can hear the family out in the living room fucking screaming. My kids are screaming. Looks like the stream quality is doing well again. This is just kind of a trial run. We're going to start streaming publicly here. I just wanted to get everything set up to see that the quality was good. There was no lag. Looks like everything's set up here. Go over to Godell really quick. See what's up and what's not up. Industrial's having a good day. Energy having a good day. Still think materials have an opportunity here to break out into some new, well, they are right now, but I think materials are probably going to be the one of the next big sector rotations here. I don't know how long it's going to last, maybe a couple weeks. It did last time, but here we go, breaking out of a consolidation fractal after peaking in late January, and I think there's an opportunity here to take this up. This is not just gold miners and silver miners, right? This is copper miners, this is aluminum miners or aluminum-related equities. This is steel. There's a lot of different ways to play the materials-related sector. Matter of fact, since I have it up, let's go and look it up. World's best neo trader. Yeah, dude, that's a throwback. Yeah, I mean, it's, you know how people get. It's like hive mind type stuff, but it is a really good way to build a following on social media. It's fantastic. Like, build a personality around a meme stock and then only talk about the meme stock, and then monetize your account through advertisements or Elon bucks or whatever. Like, that's exactly what they're doing. And I'm not going to throw shade at it. But if your goal is to make money in the market, you should be looking at those types of people as maybe antitheses. Maybe. Okay, really quick here. If we actually dig through the XLB materials related sector, you can see it here. This is chicken scratch yesterday, but we were looking at a potential little consolidation fractal breakout. Long story short, chart pattern boys. I don't give a shit that it's a symmetrical triangle. You can draw whatever you want here. I'm not 5 years old anymore. Markets don't move based off chart patterns. They do move based off of consolidation fractals, though. So it could be a rounded bottom. It could be a symmetrical triangle. What else could you see? I don't know. Whatever other stupid fucking shape you can see. Whatever this needs to convince you that this is going to go higher, go ahead and draw it. But a consolidation fractal over the last couple of months with a horizontal level breakout into some new multi-month highs is generally a good thing. We're up in towards potentially all-time highs. Materials, you can see we are 50% chemicals, 21.5% metals and mining, containers and packaging, construction materials. Largest stocks here by weight. You have Lynn, Newmont, Freeport-McMoran, Sherwin-Williams, Ecolab, Air Products, and Nucor. So a big array of things. Lynn, I believe, is chemicals, right? Newmont is gold miners. You have copper miner. You have paint. Steel, so a lot of different areas of this materials-related ETF to choose from. So it's not just gold miners, it's not just silver miners. There's a little bit of everything here. We took a trade a while ago on ERO. This looks really good for a global copper miner play. ERO. I haven't looked at these lately, but you have Steel Dynamics, which is a steel-related name. You have Nucor, which looks like it's up in towards all-time highs. You have AA, which we actually made money on. I don't know where it is right now, but we made money on Alcoa. This is an aluminum-related play. You have the gold miners. I kind of went through those. I went through some silver miners. I think if there's anything else that stands out to me. You have the chemical-related names. I think it said Lin. I haven't looked at these, but Lin, I did not take that. There was also there's Dow, which we had at one point. I think we were able to sell a double, but we didn't make any money off it. DOW. So a lot of different areas of the market there represented within the materials sector. It looks good. So many meme stocks over HIMS. Yeah. HIMS. Listen, I got no hate for HIMS. It's just an easy picking. What I mean by people building these personalities around these meme stocks is just like, I look at that stuff and I couldn't get farther away from these types of setups. HIMS, passionately, I just deleted it last week, but HIMS I had written, this is a shit stock, and I wrote it up here. You don't want to own something that's trading like this. That's insane, at least from a trading vehicle standpoint. And this is just a classic backside fade. You get the big move down. Who knows? I don't know if it's going to bottom here or not, but just like with Palantir, this thing drew down 81% from its highs back in February. So if you built a personality around HIMS, you held through an 80+% drawdown, and that's insane. That's a little crazy to me, at least personally. A little crazy to me. Okay. All right. Well, this was productive. Like I said, quality's good. Looks like everything worked well. So, Randy, we can start doing these more often. I'll probably hop on after lunch to run another impromptu session, and I'll be doing some research there. So, if you're here and you want to watch me flip through some charts and kind of take notes and stuff and go through the TTI scanner, etc., hop back on. If not, enjoy your guys' day. I appreciate you guys hanging out. Thanks for the questions, and I will catch you in the next stream. Enjoy your lunch, folks. See ya.